Welcome everyone to our channel, It's Your Money. In this video, we're continuing our series on understanding the world of finance and investing. And today, we will dive deep into the world of options trading. We will explore the two main types of options, call options and put options, both basic and advanced strategies of each, and the risk and rewards of options trading. But that's not all. Besides two no call and put trading strategies, we'll also be discussing two more strategies you may not yet have heard of. So whether you're a seasoned investor or just starting to learn about the stock market, this video is for you. Be sure to check out our other videos in the series, if you haven't already, and click the link in the description or the cards above. So grab a pen and paper, get comfortable, and let's get started. The ins and outs of call and put options. Picking a successful trade is almost as thrilling as hitting the jackpot on a slot machine or hitting 21 in blackjack. It's a feeling of accomplishment and satisfaction to watch a stock in which you anticipated to rise begins to soar. Just like how you would place a bet on a roulette table, when you're trading options, you are essentially placing a bet on the future value of an asset. The difference is, instead of betting on a number or color, you're betting on whether the price of a stock will increase or decrease. And, just like in a casino, you have the potential to make a big profit if your prediction is correct. But you also risk losing the money you are betting. Or in the case of a stock option, you can lose your deposit or premium if the market doesn't move in the way you expected. It's important to do your research and consult with a financial advisor before making any investment decisions. How to use call and put options to generate income and hedge against market volatility. One of the main ways many investors use options to speculate on market movements is by using a simple strategy called a long call or a long put strategy. In a long call strategy, an investor buys a call option on a stock they believe will increase in value. The long call option strategy is a bullish play that is used to profit from an expected increase in the price of the underlying asset. The long put strategy is used when an investor believes that the price of the underlying asset, usually a stock, will decrease thereby purchasing a put option. The long call strategy. The long call strategy is a strategy where an investor buys a call option on a stock they believe will increase in value. This gives them the right, but not the obligation, to buy the underlying stock at a specific price on or before a specific date. If the market goes against their expectations, they can choose not to exercise their option and limit their loss to the premium paid for the option. However, if the stock price increases, the value of the call option increases as well, allowing the investor to sell the option for a profit or exercise their option to buy the underlying stock at a lower price and sell it for a higher market price. The potential profit from this strategy is unlimited, but the potential loss is limited to the premium paid for the option. Long call options in practice.
Meet John. He is bullish on the technology sector and believes that XYZ tech stock will increase in value in the near future. During his research, he decides to use the long call strategy to profit from his belief that the stock will rise. On January 9th, John decided to buy a call option on XYZ stock with a strike price of $50 and an expiration date in 3 months. The premium he pays for the option is $2 per share. In case you have forgotten, this means the call option will give John the right to buy XYZ stock for $50 April 23, 2023. Now, if John is right, and the price of XYZ goes up $5 to $55 February 5, 2023, then John's call option should increase in relation to the options Greeks, which we will study in our next video.
At this point, John has a couple of choices while using the long call strategy. He has the option to exercise his right to buy the stock at $50 right then and profit from the increase in the stock's price. He can exercise his option to sell the contract to another investor for a profit, assuming that the option's value has increased in relation to the increase in the stock price.
John can also choose to hold onto the option and wait to see if the stock price continues to rise. If the stock price does indeed continue to rise, John can sell the option for an even greater profit before the expiration date. However, if the stock price does not increase or even decrease, John's potential loss is limited to the down payment. That is the option premium he paid for the option. Ultimately, John's decision on what to do with the option will depend on his investment goals and risk tolerance.
The long put strategy. In a long put strategy, you as the investor would purchase a put option if you believe the price on the stock you are researching will decrease. This gives you, the holder of the put option, the right but not the obligation to sell the underlying stock at a specific price on or before a specific date. Again, that is why it is called an option. You as the buyer have the right to sell shares of XYZ stock at a set time in the future, if you want, for a certain price. After doing more research, John believes that XYZ stock is due for a correction and decides to use the long put strategy to profit from his belief. On January 9th, he buys a put option on XYZ stock with a strike price of $50 and an expiration date in 3 months. The premium he pays for the option is $2 per share. This means that the put option will give John the right to sell XYZ stock for $50 April 23, 2023. Now, if John's assumption is correct and the price of XYZ falls by 15% to $42.50 by February 5, 2023, then John's put option should increase in relation to the option's Greeks. At this point, John has a couple of choices while using the long put strategy. He has the option to exercise his right to sell the stock at $50 right then and profit from the decrease in the stock's price. He can exercise his option to sell the contract to another investor for a profit, assuming that the option's value has increased in relation to the decrease in the stock price. John can also choose to hold onto the option to sell XYZ stock at $50 and wait to see if the stock price continues to decrease. If the stock price does indeed continue to decrease, John can sell the option for an even greater profit before the expiration date. However, if the stock price does not decrease or even increases, John's potential loss is limited to the down payment, that is the option premium, he paid for the option. Ultimately, John's decision on what to do with the option will depend on his investment goals and risk tolerance. The short call strategy. A short call option strategy is used when an investor believes that the price of a stock will decrease or stay the same. Known as writing a call, the investor will sell a call option on the stock they believe will decrease in value or stay the same. Remember, in our first example, John bought a call option for April 2023. And when John bought the call, he had to put a down payment called a premium to get the rights to the option. In the case of the short call strategy, it is you selling the call to John. When you do this, it is you that will receive the deposit or premium from John for selling the call option. This strategy is used as a form of income generation by many investors. But it also carries the risk that the stock price will increase, and if John decides to exercise his call option, you will be obligated to sell the stock to him for $50 even if that means you have to buy the underlying asset at a loss. It's important to note that the short call strategy is a form of selling naked options, that is, promising to sell shares of XYZ even though you do not own them. And you may be wondering. Yes, a normal retail investor can implement a short call or short put strategy in options trading. However, it is important to note that these strategies are considered more advanced and carry a higher level of risk. Retail investors should have a good understanding of options trading and the potential risks and rewards before implementing these strategies. It is also important to consult with a financial advisor or professional before making any investment decisions. The short put strategy. The short put strategy is used when an investor believes that the price of a stock will increase or stay the same. Known as writing a put, the investor will sell a put option on the stock they believe will increase in value or stay the same to someone who believes the stock will fall. Remember, in our first example, John bought a put option for April 2023. When John bought the put, he had to put down a down payment called a premium. In the case of the short put strategy, it is you selling the put to John. When you do this, it is you that will receive the deposit or premium from John for selling the put option. And if John decides to exercise his put option, you will be obligated to buy the stock for him even if that means you have to buy the underlying asset at a loss. It's important to note that the short put strategy is a form of selling naked options as well, that is promising shares of XYZ even though you do not own them. And this carries more risk than selling covered put because in a covered put strategy, you actually own the stock. In conclusion, we have discussed the basics of options trading and the different strategies that can be used. We went over the long call strategy where an investor buys a call option in the belief that the stock price will increase. We also discussed the long put strategy where an investor buys a put option in the belief that the stock price will decrease. We then covered the short call and short put strategies where an investor sells a call or put option, respectively, in the belief that the stock price will stay the same or decrease. We hope that this overview of calls and puts has been helpful in providing a basic understanding of the different strategies that can be used. Remember that options trading can be a high-risk and complex endeavor, and it is important to do your own research and understand the risks involved before investing. Have a wonderful day. See you in the next video.